Welcome to this explainer. Now look, if you think accounting is just some dull, repetitive process of pushing numbers around on a screen, well, I invite you to think again. Accounting is actually a highly satisfying organization masterclass. Imagine a really bustling, complex business as a massive sorting office. Every single day, hundreds of letters, packages, and parcels, representing financial transactions, right? They all arrive. If we just toss them all into one giant pile, we'd literally never find what we need. So today, we're going to look at the absolutely brilliant system used to organize all this chaos.
Okay, let's dive into this. So what actually happens if you try to record every single business transaction in one main ledger? Well, sending every tiny transaction straight to the nominal ledger, which is the big book of accounts, creates a massive, chaotic traffic jam of data. It's like gridlock. The accounts become incredibly overcrowded, making it virtually impossible to prepare accurate financial statements at the end of the year without getting hopelessly lost in the weeds. No way we can let that happen.
And that brings us to our perfect solution, a book of prime entry. You can think of these as the local side roads and sorting bins that stage information first. Basically, it's a book in which transactions are recorded in date order before they become a part of the actual double-entry bookkeeping system. We capture the transactions exactly as they happen, before they're forgotten, keeping that main highway totally clear.
So, here is our agenda for today. First, we'll look at the ledger traffic jam. Second, mastering the cash book. Third, the petty cash system. Fourth, journals for credit transactions. And finally, the general journal. Let's get right into it.
Section 1. The Ledger Traffic Jam, Avoiding Overcrowded Data. Using these books has some major advantages. You see, instead of doing complex double-entry logging for every single tiny sale the second it happens, these books just list the transactions as they occur. This means your month-end totals can be easily calculated and posted all at once. It prevents nominal ledger overcrowding, it's so much quicker, it allows multiple staff members to work on different books simultaneously, and honestly, because the whole process is simpler, it drastically reduces errors. It's a real game changer. Section 2. Mastering the Cash Book. Managing Liquid Assets.
So the crucial point is the cash book is incredibly unique. It actually has a dual function. It is a book of prime entry, meaning it's the very first place cash and bank transactions are recorded, but it is also a ledger account for bank and cash. This means the cash book follows the rules of double entry all by itself. Money received is debited and payments made are credited, right there in the book. In a two-column cash book, you'll notice the separate columns for cash and bank on both the debit and the credit sides. See that letter C sitting there in the details column? Well, that stands for a contra entry. If you take cash from the business till and deposit it into the business bank account, you have to credit the cash column and debit the bank column. Because both of those accounts live side by side in this exact same book, both entries happen right here. The C basically tells the accountant, hey, the double entry is already completely finished within this single book. Now, I want you to focus on this number for a second, 0. While your bank column in the cash book can absolutely drop below 0 and have a credit balance, thanks to bank overdrafts where the bank loans you money, the cash column can never drop below 0. Why is that? Because physical cash is a tangible asset. Once the cash in the till is used up, it's gone. You just can't have negative physical coins and bills.
Of course, not all money that comes in actually stays, right? A bank might reject or bounce a check for a few different reasons. Maybe there are insufficient funds, an irregular signature, or maybe it's stale, meaning it's over 6 months old. It could also happen if there are weird alterations on it or if it's post-dated. Whenever a check is dishonored like this, the original entry in your cash book has to be reversed. You literally have to credit the bank account and debit the customer's account all over again. Now, what's really interesting about this slide is how it completely clears up a classic accounting confusion. Trade discounts versus cash discounts. Okay, so a trade discount is given to customers who buy in bulk. It is simply deducted right there on the invoice and is not documented in your accounting records at all. A cash discount, however, is a prompt payment incentive. This one absolutely is recorded in the books of accounts as either a discount allowed to a customer or a discount received from a supplier. Make sense? And because cash discounts are recorded, well, we need a place for them. Enter the 3-column cash book. You'll notice we've added a discount column to both sides here. These extra columns track the cash discounts. And just like we discussed earlier, we do this so we don't overcrowd the nominal ledger. At the end of the accounting period, only the grand totals of these discount columns are actually posted to the ledger. Pretty neat, right? Section 3. the petty cash system, small cash transactions.
The petty cash system runs on what we call an imprest, or a float. So an imprest is basically a fixed amount of money with which a petty cashier starts an accounting period. This is brilliant because it allows a junior staff member to handle all those minor, low-value day-to-day expenses without constantly bothering the highly paid chief cashier.
Let's walk through the exact step-by-step logic of the imprest loop. It goes like this. First, the chief cashier gives the junior petty cashier the fixed imprest amount. Let's just say $150. Second, during the month, the petty cashier pays for small expenses, like stamps or coffee, and collects a petty cash voucher and a receipt for every single one. Third, at the very end of the month, the chief cashier reviews those vouchers and restores the exact amount spent. So if $100 was spent, the chief cashier hands over exactly $100, bringing the float right back up to that starting $150. Control is perfectly maintained the whole time.
And this brilliantly illustrates the layout. Notice those columns on the right? These are analysis columns within the analytical petty cash book. Every payment is entered twice, once in the total paid column, and then again in a specific category column, like travel, cleaning, or stationery. These expenses are categorized horizontally as they happen, so at the end of the month, only the neat, summarized column totals are sent over to the ledger.
Section 4. Journals for credit transactions. Delayed payment records. We have two main bins here, the sales journal and the purchases journal. Now, I really must stress this heavily. These specific journals are strictly, entirely, 100% for credit transactions, okay? Cash sales go in the cash book. But if a customer buys from you on credit, it goes in the sales journal, derived straight from your copy invoice. If you buy goods on credit from a supplier, it goes right into the purchases journal. Let's move to and see how this builds when things don't exactly go as planned. Because what happens when goods actually get sent back? Well, we have returns journals for that. If a customer returns goods to us, we issue them a credit note and record it in the sales returns journal, which is also called returns inwards. If we return faulty stock to our supplier, we receive a credit note and record it in the purchases returns journal, or returns outwards.
Section 5. The general journal, the final sorting bin.
So, if a transaction doesn't belong in the cash book, the petty cash book, or literally any of the credit journals, it lands right here. We use the general journal for opening entries when a business first starts keeping its books. We use it for writing off irrecoverable debts, say when a customer goes bankrupt. We also use it when buying or selling non-current assets, like heavy machinery, on credit. Without this particular journal, these crucial but infrequent events would be completely forgotten before ever hitting the main ledger.
Notice the format here. You list the date, the account to debit, the account to credit, and then, right down at the bottom, the narrative. This part is absolutely crucial. Every strange, one-off transaction gets a brief story or explanation attached to it. This way, any accountant looking at the general journal a year from now knows exactly what happened and why this entry even exists. As it's beautifully summed up, the general journal is a sort of diary. And honestly, that's the core philosophy of all these books of prime entry. They simply exist to keep the main ledgers immaculately clean while acting as a detailed diary that tells the day-to-day story of the business efficiently and accurately. I'll leave you with this provocative thought as we wrap up this explainer. If a business goes completely cashless in the future, relying purely on digital transfers and credit, which of these sorting bins becomes entirely obsolete tomorrow? How would the cash book and the petty cash float adapt? It's a fascinating way to test your new knowledge of the system. Thanks for exploring the sorting office with me today. Keep organizing those inputs, and I'll see you next time.